The ripple effects of inflation are reaching every corner of American life. Target confirming their second quarter profits plummeted roughly 90% from last year.
Target takes a tumble. Profits plunge after some very disappointing numbers on Wall Street. Officials say that profits are down 90%.
Here's another story that is making headlines. Target basically losing more than $9 billion in market value in just 1 week.
The retail giant has reportedly lost $9 billion over LGBTQ and particularly trans-friendly kid clothing.
Target, that major U.S. retailer, losing billions of dollars in market value.
Target is one of the largest retailers in America, but it seems to have been struggling to keep its head above water as of recently. In the past year, the company's profits have plummeted by a mind-blowing 90%. We're left asking two things. What's causing this collapse? And is Target headed for disaster? Hello, and welcome back to Serious Coinage. In this video, we'll take a deep dive into Target's current issues. We'll talk about the factors that have contributed to the company's downfall and assess whether Target can turn things around. Be sure to watch until the end if you're interested in learning more about Target's future. Recent months have seen a slowdown in economic demand in the United States and across the globe. Many consumers are decreasing their discretionary expenditure because of rising prices and stagnant wages. Moreover, many businesses are also dealing with rising input costs as the cost of energy and other commodities rises. At the same time, rising interest rates, which reduce the amount that people and businesses can borrow and increase interest costs, make the problems even worse. Due to these economic trends and the shrinking of competitive moats when compared to online retailers like Amazon, ticker symbol AMZN, department shops have especially significant risk exposure. Due to this, investors may be concerned about the future of higher quality retail stores like Target, ticker symbol TGT, considering current economic conditions. Similar challenges affect Target, but growing inventory, inadequate working capital, and precipitous drops in net income stand out as particularly worrisome. At first, Target was able to sustain profit margins by passing on increased input prices to customers, just like its competitors. However, Target is currently experiencing margin strain as it works hard to keep prices up with input costs while maintaining sales in the face of persistently low customer confidence. While trading at a forward PE of 19x, TGT has lost roughly 40% of its value last year. So, now is a good moment to take a closer look at the company to see whether or not it has fire sale or falling knife potential. Target, becoming overly ambitious or greedy. Target, in contrast to Kohl's, has done exceptionally well during most of the past decade. The proportion of the company's overall sales is attributable to its online footprint, and online sales account for about 20 to 25%. The company has also become known as a premium department store, one that offers more upscale goods and features a more enticing layout. The gross profit margin of Target is higher than that of its main rival, Walmart. However, experts see this as a two-edged sword. Target was able to expand rapidly and compete successfully with Amazon when times were good because of its luxury business branding. However, due to current economic conditions, consumers attempt to cut back. Target's higher price exposes the company to more risk. Both Target and Walmart have seen their gross margins drop in previous years, but Target's drop has been more severe, to the point where its most recent quarterly gross margin was lower than Walmart's. Moreover, Target's hunger for expansion over the past 5 years has made the company less resilient to downturns in the economy. Now that the company is experiencing recessionary dynamics, its underlying structural flaws are becoming apparent. Signs of economic decline shows a drop in EPS. The strength and scope of the economic storm, as well as Target's business fundamentals, will determine how well the retailer will cope with the economic downturn. Because of this, it's possible that Target's sales will fall even worse next year than they have in the past. The company announced its earnings per share of $2.05 in the first quarter of 2023, which was down 4.8% from the previous year. With inventories remaining high from the prior quarter, experts anticipate additional negative profit surprises for Target in the second, announcing on the 16th of August, third and fourth quarters as the economy continues to deteriorate. Moreover, unless economic indicators improve, experts believe Target's EPS will be negative for the majority of 2023. Inflation that refuses to abate and a decline in the financial security of households make a recovery of the economy in 2023 is quite doubtful. Target is entering this storm with extremely low liquid current assets in relation to its current liabilities. Therefore, if it is unable to sell its inventory at a profitable price, it may need to obtain debt or sell equity to enhance its working capital. Target could end sooner than most people think. Target is doing the worst out of all of the big stores in the United States right now. New data shows that even the top executives of the chain admit that it has serious problems that are hurting its bottom line in a terrible way. In the past year, Target's income fell by 90%, which was never seen before. Its plan to raise prices in 2023 to make up for these losses is doing more harm than good for the retail giant. People don't want to buy 60% of the company's products, and the remaining 40% are much more expensive this year, so they go to other stores for their everyday needs. Investors and big financial institutions are pessimistic that sales will increase for Target anytime soon. No one has the courage to admit the obvious. The state of Target is fast worsening. Its demise may perhaps come sooner than expected. The store is best at selling clothes, accessories, and home goods, which are exactly the kinds of things people are ignoring because of high inflation. Target's sales growth in the first quarter was scarcely noticeable, and the firm will require a robust back-to-school shopping season to remain at the higher half of its already low sales target for 2023. However, wealthy households are the ones that are most likely to shop at Target. Despite its modest size, the shop can corner a sizable enough share of the market to ensure continued high profits, even in the face of flat or falling overall sales. So far, we've talked about some of the factors that have contributed to Target's downfall. But what do you think? Do you think Target can turn things around? Or is the company headed for disaster? I'd love to hear your thoughts in the comments below. Leave a comment relevant to the topic, and I'll be sure to respond. Attempting to strike a balance between expect more and pay less. According to Placer.ai's analysis of data from STI, PopStats, Target is performing better than expected. Target is approaching 17.8% of the homes with incomes over $150,000 per year, but it has captured 19.6% of those households. This is, in some respects, not unprecedented. Target has traditionally been seen as a more glamorous bargain retailer than competitors like Walmart Stores Incorporated, ticker WMT, and Amazon.com Incorporated, AMZN, in large part because of its unique design collaborations with notable designers such as Michael Graves, Jason Wu, Kate Spade, and Missoni. And for that reason, the company's slogan puts it, expect more, pay less. However, Target advertises itself as a store that welcomes customers of all socioeconomic backgrounds. The store occasionally forgets this, it appears. The company's disastrous collaboration with Neiman Marcus during the holidays is a prime example. Target's excessive asking prices were a major factor in the collection's failure. And for years, Target did a terrible job of stacking its shelves with food and groceries, the non-discretionary categories that bring customers back to the shop again and again because they must restock their pantries. The company's leadership, led by CEO Brian Cornell, has prioritized rebalancing its portfolio, beginning with products like milk, eggs, and cereals. The company said that Target went into 2023 after 3 straight years of unprecedented growth and market share wins in food and drinks. The bottom line. For now, Target doesn't look as bad as Kohl's, mostly because it has a wide range of products and a strong name in general. Target's main advantage may be its premium brand value, which is hard to measure since its book value is only about 1/7 of its market price. However, Target's higher prices may cause it to lose a lot of the appeal it has acquired over the past 10 years as individuals try to cut back on discretionary spending. In essence, it appears that the general retail trend favors ultra-low-cost businesses, such as Amazon and Walmart, and specialty small businesses, brick-and-mortar merchants for customers seeking high-quality, high-cost goods. Target has made a name for itself by being in the middle of this range. Since economic downturns cause big and lasting changes, a company might not have as strong a base as many shareholders think. It would be a shame to see such a cherished retailer go down in flames like so many others have before them, but retail is a fiercely competitive business, and Target's rivals are stepping up their game as the company crumbles around them. Thank you for watching, and do not forget to hit the notification bell and subscribe for more.